cover the basic concept of accounting. I'm going to define some accounting words, and then we are going to practice some accounting transactions. But the first question we could ask is, where does an organization get the money from? How do I make accounting entries in the journal? Or how do I book my accounting transactions? How do we use a chart of accounts? What ledger T account, general ledger, trial balance are used for? And so on. Businesses receive bills and invoices, pay their suppliers and vendors, receive money from customers by selling them products or services, and then pay their employees. Okay? We do a sort of accounting ourselves on a daily basis. We get our paycheck, go to the bank to make deposit or withdraw money, buy things or groceries, fuel for our cars, and we pay electric and rents and phone bills, etc. So we are doing some accounting in a daily basis. Some people write down what they spend, what they receive, paper or spreadsheet, and you can actually do some accounting yourself. You can write down your expenses, your money that you receive, and keep track of all your transactions on a daily basis for each week. All companies, even though they have agricultural software, they use Excel as well for some other work, such as keeping track of amortization, depreciation of their assets. We are going to answer all those questions during this course journey. First, let's talk about some accounting requirements in business. Companies must keep financial records of day-to-day operations, transactions. The purpose of having an accounting system is, one, companies can manage their resources, money, employees, products, and all services, their customers, suppliers, vendors, transactions, etc., for their business. They also pay attention to revenues or sales and operation expenses to make a profit, right? Accounting results help managers in making decisions. And two, after the end of each year, all companies are required by law to submit their financial statements and income tax payment to the IRS, the Internal Revenue Services, or tax administration. We all do file our tax at the end of each year. So we pay tax ourselves, and we should keep track of all our expenses. In case companies don't submit their financial statement, pay taxes to the IRS, tax administration, they are going to be in trouble. And they are going to pay some extra fees and penalties for being late to pay their tax too. Okay? Then we are going to highlight the importance of the information presented in the report we call financial statements. There are 4 financial statements. First one is the income statement, which provides information on the company's financial position. Is it accurate? It lists all expenses incurred during the same period and indicates whether they generated a profit or a net income. We then move to the statement of shareholders' equity and retained earnings. That's the second financial report. What did we do with the profit? Did we keep it in the company or distribute it to shareholders? Then we are going to move to the balance sheet, the third financial statement. Okay. which tracks the value of assets, valuable possessions that will benefit the company in the future. How much debt do we have? What do we owe our creditors? And finally, net worth, which belongs to the owner of the company. We also have the fourth financial statement, which is the cash flow statement. The cash flow statement answers the questions, where does the money come from and what is it used for? Now, how do we get the numbers that will ultimately appear in the financial statement? The first step in our process is to determine how a business will raise funds, what we call financial activities. Actually, all companies, small businesses, partnerships, proprietorships, or corporations, they do three activities. The first one is financial activity. The second is investing activity. And the third is operations activity. We're going to see all those three activities later on. So let's start with financial activity. Right? We're going to write it down. Where will the capital the company needs come from? And from what source? We have two options. Either the owner, business owner, will contribute and submit some money to the bank to raise his or her capital of his business. And the second option is to borrow money. We are going to see those two options. So the first option, option number one, we are going to get money from owner, which is contribution. Contributions of the money by the business owners go to owners' equity. Okay? Right? And we are going to have the second option, which is borrowing money from a bank or a financial institution, and we are going to book that transaction as a debt, which is a liability. A liability is what you owe to others. You get money when you buy something on account, so you are going to book that under liability that you're gonna pay later on. Okay? So the second option is borrowing money. That goes to liability accounts. Okay? It's a debt. And we are going to illustrate that on T accounts. A T account has a debit and credit. Think of when you go to your bank, you withdraw money, so that money belongs to you, is a debit. However, when you pay a bill and you spend money, that is a credit from your pocket or from your wallet. So we always have two transactions. We have debit an accounts and credit an accounts. If you buy, you are going to credit your accounts and debit another account which is expense. Okay, so two accounts, debit and credit. That's how the T account functions. Okay, I'm gonna withdraw. It looks like a T. Okay, and it has a debit and a credit. Debit is usually presented by letter D. Okay, and credit usually is presented with CR. To say is a credit. Okay. Now, let's say the business owners give the company some money. We're going to say, for example, $10,000. So we are going to debit what? To debit our bank because we received that money from the business owner. We're going to put it into our bank accounts. So we're going to name this T account as a bank account. Okay? I'm going to circle that in red.